Welcome back to another episode of Palisade Radio. I'm your host, Karem Mutlu. And on today's show, we welcome Sam Laakso, who's the founder at SKL Capital. Welcome to the show, Sam.
Thanks for having me.
I understand that throughout your career, you have been trading stock indexes, currencies, gold, silver, and oil. So talk to us about your background, Sam, and how you began your journey into the world of commodities and trading. I understand you're based in Finland.
Yeah, that's correct. So I'm based in Finland, in Helsinki, and I started investing when I was 15 years old. And in 2016, I started trading actively, basically just futures and options. First I was trading mainly futures and then some ETFs, but after that it got banned in the European Union. So you cannot trade any more ETFs unless you're like a professional trader. Or you have some kind of status like that. So nowadays I'm trading mostly options and I focus on currencies and gold. I used to do quite a bit of stock indexes in US, but nowadays my work is so busy that trading is more of a hobby with me. So just a year ago I was working in Amsterdam as a derivatives and commodity derivatives and equities broker. And nowadays I'm working as a gold broker in Finland.
Well, let's talk about gold and silver today. For you, Sam, was late 2015 the end of the bear market for the precious metals? And talk to us about the price action for gold recently and what it may mean going forward.
Well, yeah, definitely the 2015 bottom was the bottom of the bear market, in my opinion. I don't really believe that we're going to visit those lows in my lifetime or as long as we have the US dollar system working as it is at the moment. So I really believe that in the next financial crisis or next recession, we're going to see a currency crisis. And so I really think that the 2015 lows were the absolute lows for the US dollar price of gold. And lately gold has been rising over the past year and 6 months especially. And so nowadays, just a month ago, it's been kind of going sideways or going lower. I really believe that it's going to go a bit more lower, maybe retest the 2016 highs, which was like we had a long sideways consolidation after the 2015 bear market bottom, and I think that we're going to retest those 2016 highs before heading higher. So I really think that by the end of the year, gold will be higher, but over the next couple of months, or let's say just 1 month, I think that we're going lower.
Very good. And if this is the case of gold bottoming out and heading much higher over the next few years, what's the potential for the juniors within this space? The junior has been beaten down for such a long time, so the potential leverage could produce outstanding returns eventually. What's your view on this? How do you analyze them?
Yeah, of course. I haven't really been actively following the junior space. I had an interview with David Morgan for my thesis last year, and he talked me about the junior mining space, and that just a handful of companies actually make it to the end production. And so I don't really follow the junior miners that much. If somebody is able to follow each and every single company in the space, that's great for them. They can offer a huge leverage. I mean, I know that in the 70s, some junior miners went from just a couple of cents to $50 per share. So there's definitely high leverage available, but that's not really the case for every single junior miner. And so I don't really think that for example, the GDXJ is that good of an investment. It's more risky. And of course, it will provide some leverage, but the leverage also comes to the downside. And so I would stick with the metals and just use leverage on those if that's the case. Or then if you have some time to analyze really the junior mining space, then you can do individual company analysis and that's fine. Then you can use that as your leverage. But I really personally don't go into the junior mining space.
You have written a 200-page report on the gold market entitled The Future of Gold for the Next 20 Years. And there is a section within the report about the structure of the gold market itself, financial market manipulation, and market efficiency. So talk to us about these topics in more detail. And for you, which catalysts are the most important when looking at the gold market today?
Okay, so you mentioned my thesis. It's quite a heavy thing to read on one sit. So there's a lot of small components that I look into the gold market in my thesis. And so the structure of the gold market is one. So basically, most of the physical flow goes nowadays in the Chinese market, which is really just an Jan Nieuwenhuis has been talking about this, and he's definitely a good follow on Twitter. He's been talking about it, but not most of the people in the West analyzing the gold market don't really look into the Chinese market in depth, and that's also something that is, in my opinion, one of the most interesting and most important thing in the whole gold mining space. So for the manipulation, there's all sorts of talk that the gold price has been manipulated down for a long time. There's not really evidence for that. There are these huge dumps, which I go through in my thesis. There are huge dumps going on in COMEX in pre-market, which are definitely not normal market behavior, but those have been quieted down. So in 2016, 2017, 2018, there were a lot of these pre-market dumps on COMEX, which set the price going lower, and they usually occurred close to bottom of some of these smaller cycles that I actually follow as well. And so there is definitely gold price manipulation going on, spoofing, for example, but it goes both ways. So gold market is manipulated both to the upside and both to the downside, and that's something that we already know. But the question is the gold price has it been actually suppressed for a long time, like for years, for example? And there's not really true evidence for that. But in my personal opinion, there is something really suspicious going on in the pre-market attacks on COMEX gold price. And so market efficiency, I talked with Alex Stenfors. He was one of the biggest traders in currencies in early 2000s, and he actually wrote a book about the LIBOR scandal, the barometer of fear. And I read the book, and then I discussed the book's content with Alexis, and he said that he has never met a single trader in his whole 15-year career in investment banking trading that someone would have thought that the markets are efficient. So it's really a no-brainer to me that the markets are not efficient. That's also one of the reasons why there's the systematic risk, for example, hasn't been counted into the gold price yet. So I think that the gold price is going to go higher over the next few years, maybe 5 to 10 years. So the systematic risk hasn't been discounted into the price. And so I don't really think that the markets are efficient. There's obviously going on some manipulation, which also says that the markets cannot be efficient if there's some manipulation going on. And so I just think that the efficient market hypothesis is kind of a joke in my personal view. And so for the catalysts for gold, I'm really looking forward to seeing how the Fed's balance sheet will grow over the next couple of months. So now we've seen this repo scandal evolving, and that's really one of the most important things on the market at the moment, actually. So another great follow, Tuomas Malinen, he's a friend of mine. He works at the GNS Economics. They've been tapping into this repo market situation for the past couple of weeks in depth, and they really think that there's something big and fishy going on. Some say that it's already GUI4 going on with the Fed's balance sheet. I'm not really ready to pull the trigger at the moment for that call, but I do think that this is a big catalyst for gold for the next couple of years. So if the Fed is really going to start dumping just dollar bills into the market via the repo market or something else, that's really going to set the sparks on gold.
Excellent. And if gold is set to move higher, as you suggest, over the next 5 to 10 years, I assume that there will be mini bull and bear phases or mini cycles throughout this. I think it'd be interesting to talk about cycle theory and why it's important for investors.
Yeah, sure. So I learned cycles from Gary Savage. He has this Smart Money Tracker blog. It's a great blog. I recommend you to follow it. So cycles basically work in a common sense way. So basically markets are all about sentiment and cycles. So sentiment is what drives the prices on the short term up and down. So if you have like short term intraday traders, they tend to be bullish or bearish intraday. So there's a lot of people like those on the market, and that moves the market intraday. And so then there are these directional traders who take positions for a week or just a couple of months, and those move the market on that time scale. And then you have these speculative traders who takes positions for just a couple of years or so, and then you have these longer term investors who try to catch the bottom of the bear market and try to catch the top of the bull market. So it's all about market participants trading each other over different time periods, and those create the cycles. So the position traders create the intermediate cycles, and the shorter term traders create the shorter daily cycles, as they're called. So it makes really sense that if too many people are bullish on the short term, then there's not going to be any buyers at some point, and the price has to go down. And the same thing happens on the downside as well. As soon as every single short-term trader is bearish, all of the technical indicators are bearish for the equity or the gold you're following, then we have a bottom. And then comes the cycle's timing bands. So basically you have these timing bands which tend to be from 30 days to 60 days in the daily cycles, and then you have longer cycles which have 15 to 30 weeks, for example. And so it's all about basically common sense on how sentiment affects the market, and then you can put a timing band and see from the historical charts. You can just calculate all of these, all of the daily and intermediate cycles and yearly cycles that happen on the market. That's one thing that I talk about in my report, and that's one thing that I really believe in, because I believe that the ruler, for example, is an invention of the engineer. So everything in nature is cyclical. So it makes really sense that humans are also cyclical, and that means that we think cyclically. So people get down and then they get up, and then it's all about going up and down. And that price movement goes into sentiment, which translates into cycles. And so that's the basic idea about the cycles theory. And so you can read more about it in my thesis, of course, and then you can follow Gary Savage. He's a really great cycles trader. But that's really something that I believe that is driving all of the markets on the short term, intermediate, and the long term. So it's all about, on the long term, it's all about fundamentals, but how we get there is all about cycles.
Excellent. Okay, let's move on and talk about a few books that have helped you within your research and for when you're looking at the markets. Which have been the most important to you as an investor, Sam, especially in the gold and silver space?
Well, for the gold and silver space, I haven't really been looking into too many books. I've been coming into the market from the trading perspective. Of course, you can go through my sources list on my thesis, so there's probably more than 100 sources that I used. But for books in general, what I think are great, I think that Market Wizards is a must. Everyone who tries to trade anything, they should read Market Wizards. It has a lot of good lessons on how traders have lost their money and still made fortune in the end. And another great book is the Alexis Stanford's book, which I already mentioned, The Barometer of Fear. That's really what said to me that the markets cannot be efficient. He talks about the foreign exchange market, which is the largest market on the planet. So basically, if that market cannot be efficient, then none of the markets can be efficient. So those are the two best books, in my opinion, what people should be reading. And then there are others, of course. For example, How Nations Fail. And I also like Jim Rickards's books. You have to remember that he basically tries to sell his books. And so he has this kind of a dilemma of saying things that are horrible and seem really bad, because they raise the interest of people. But they have a lot of good points in them. And so I really like Rickards's books as well. I think that would be it for myself. I'm dyslexic, so I really like to listen to podcasts and I really like to watch some videos. I'm a big fan of Peter Schiff, although he is also an ultra bear, so he doesn't really recognize all of the potential in the markets, and he tends to be early, which is of course better than being late. But I personally like to follow a lot of people on Twitter, and I watch people's videos on YouTube and listen to podcasts, and that's really the way I like to gather information. But those are just a couple of good books that everyone should read, in my opinion.
Fantastic. Okay, as we begin to wrap up, Sam, is there anything else you wish to talk about today? Anything else you'd like to share with our listeners?
Well, I tapped into the repo market just shortly in the interview. So I really think that people should go and look into what the Fed is doing at the moment and what they are saying at the moment, because that's going to be a big catalyst over the next couple of months. So I cannot emphasize this enough that people should actually go and see how the Fed's balance sheet is evolving over the next couple of weeks. It's going to be very interesting to see. I think that this month will be kind of quiet on the markets, but the turmoil could start actually in just a few months. Of course, it's never a great idea to call tops, because people who call tops are usually wrong. But I think that we're really close to some kind of a catalytic event, and I really think that people who don't have any physical gold, they should have some. If you believe in the space, but you're all in miners, you have a lot of equity risk. So you should actually go and diversify your portfolio both into physical and both into equities if you are into equities. Personally, I'm not really into equities anymore. I just do some option trading. But physical is a must-have in everyone's portfolio if you believe in the gold market. And also actually one of the people who I follow really closely is Ray Dalio. He's been also talking about this paradigm shift which is going on. And so, yeah, go read Ray Dalio is one of my points here.
Excellent. Okay, many thanks for your time today, Sam. I'm sure we'll have you back on the show later in the year.
Yeah, great. Thanks for having me.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?